We go to Kim Forrest and Ken Mahoney. Thank you for joining us. Kim, you agree with Kathy here.
I do. And, I think it's because we both have this technology perspective. I was a software engineer before I came into the world of finance, and I know the power that software can provide to companies to make them more productive. And I think that's how she sees the world and how I see the world, is that I think it is in the long term deflationary because we can do more with less if we use technology well.
But Kim, her timeline seemed to be, after Christmas, after the holidays, you'll see that I'm right. Do you think inflation goes away after the holidays? Because so many companies warning that it persists into the second half of 2022.
I hear that, and I kind of agree with her, because if you look at how quickly lumber fell in price when supply and demand came back into balance, perhaps a lot of the things out there in the world, once the shipping lanes become open and things begin to flow around the world again, a lot of categories should fall, and again, because of supply and demand. So I'm not really often on the side of Kathy all that much, but I think we're right there with each other.
Let me bring Ken in here. We've got more earnings coming out after the bell today. We have Twitter, also Microsoft, Google parent Alphabet, Robinhood. Ken, which names here do you like?
Well, the pick of the litter has to be Microsoft. And again, you have to understand this setup is really good for earnings. I mean, sometimes we come in hot into earnings and you get to sell the news. We came limping into earnings. I mean, September was it's not a pretty picture. Microsoft, remember last quarter, they beat expectations. They raised guidance. About a $60 billion stock buyback. I think the under and over right now is $2.08. My guess is they're going to beat that by quite a bit. Now, generally speaking, we don't like to jump in front of these things. It's kind of Russian roulette. But of the four, no doubt, Microsoft is the place to be. They're killing it with web hosting. They're killing it in Xbox. And again, I definitely expect a very strong quarter and strong guidance once again.
Yeah, but the stock's at a record high, Ken. I mean, do you buy now ahead of the earnings? If you think the earnings are going to be that great, they're not going to be affected by chip shortages. People are still going to buy their Surface laptops and Xbox. I mean, you're still bullish on a stock that's run up so much?
Yes, look, we could definitely have sell the news reaction, no doubt. Look, I said I don't like jumping right in front of earnings. It's kind of like Russian roulette whether it'll work out or not. And Microsoft could definitely sell the news. But again, all the other ones, like Twitter hasn't found a way to monetize itself. Robinhood, again, that's around how many subscribers they get or how many accounts they can open and so forth. But of the four, if you had to play one of them, I would say Microsoft. Again, no doubt, you can have sell the news because it's had such a run up into earnings.
Kim, which names do you like out of those who are reporting momentarily?
Sure. Well, again, I agree with you that you maybe should wait for a pullback in these names, but there's some good names. The two that jump out to me again are Microsoft, again, for their business-oriented software, and then Google, because they do have a great core business in the whole selling AdWords, which is just printing money, right? But it is at the top of, or near the top of its price ever in the history of Google.
Yeah. And then you have Twitter. I think the expectation is 211 million active users, but how do they monetize those users? And what happens, Ken, when, next year you see Trump social?
So, yeah, Twitter really kind of shot themselves here with all of this. I mean, knocking down accounts, purging accounts. They're like the thought police. And, no matter what side you sit on this thing, you really don't like it. And they really haven't found a way to monetize it. I mean, Facebook certainly have found a way to monetize it. You can go in there and say, I want this demographic, I'm going to run this ad. I don't know. Twitter really hasn't got that, and I don't know where it is with that. And I think it comes from leadership a little bit. It seems like Dorsey's time split between Square and this company. Again, his ideology is a little bit off as far as I'm concerned. So again, I'm not a big Twitter fan at all. They haven't monetized it, and again, there's going to be more competition for other thoughts. You actually can have a conservative thought perhaps and actually post it without getting taken down. That'd be a nice thing to do.
Kim, all in macro here, what do you expect? I mean, earnings are supporting the stock market rise that we're seeing, and we should see, if the gains continue, the 57th record close for the broader market this year. I mean, for lack of a better word, it's a float up, a melt up. What's the next catalyst, if not earnings, for the stock market?
Well, I think right now it really is earnings, earnings, earnings. And then in the beginning of December, for better or worse, we have another governmental cliff to climb, right? Or to fall off of, whichever one you want to, whichever direction you think it's going. We have to get that settled. And I think that could give us some turbulence to pick up names that might go on sale. And that's what I really like to do, is when the market's selling off, is to pick up those gems that people are throwing out because they're afraid.
Yeah, and you can, I'll let you wrap it up here for us.
I think your viewers could really start watching the VIX for clues. I mean, July, August, low VIX, markets kind of grinding higher. Next thing, September, VIX rises, putting some insurance on, some scare, and then September sells off. And then what happened here in October? The VIX imploded. It was a precursor to the market rising. So I think
and it's been an October so far, despite it being a scary month historically for the stock market. Ken, thank you. Liz Klayman, over to you.